Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hi, I'm Ravi Singh, Chief Investment Strategist at Standard Chartered Bank India. Welcome to another edition of Views from the Street, bringing you market views and insights on how you should look at your investments from industry veterans and experts. Today, we are joined by Mr. Ashish Gupta, Chief Investment Officer at Axis Mutual Fund. Thank you, Ashish, for joining our podcast.
Thanks, Ravi, for having me.
So let's get to the most pressing question on investors' minds. 2023 has witnessed quite a few twists in the plot so far. We started the year with a cautious outlook on global growth and relatively less hawkish policy stance from central banks. But quite the opposite seems to be in play. So how do you see India's macro fundamentals, especially in the global context?
Hi, Ravi. Thank you for having me on this platform. No, that's a very interesting observation. 2023 has been a year of uncertainties. It has played out very differently than what we expected it to at the start of the year. In addition to the fact you mentioned, another interesting turn of events has been that at the start of the year, we expected China to have a strong year after its post-COVID opening up, and US to have a major slowdown after the 500 basis point rate hike by the Fed. Ironically, what we have seen is US growth better than expected, and in contrast, China has gone from not just a cyclical, but really concerns about a structural slowdown with issues around leverage levels, issues of overbuild in its real estate sector. I think where the markets were surprised was that despite the fact that US rates went up by 500 basis points and early on there was a monetary tightening, in the month of March and April, there was again a flood of money printing in the US following the Silicon Valley Bank crisis. In addition, the US fiscal remained excessively loose, and in the first half of the US financial year, the fiscal deficit actually jumped from 3% of GDP to 6% of GDP. Right? So there was a 300 basis points boost that came from the fiscal side, which was unexpected. And what that has meant is that the US recession, which was expected in the third quarter of 2023, has not materialized. My belief still is that we are still going to have a recession in the US. It's a recession delayed rather than averted. And the recession more likely is to now be there in first quarter of 2024 rather than be a 2023 event. The central banks are likely to persist in the US with higher rates. While we may be peaking in terms of rates, I don't think rate cuts are going to immediately follow, given how sticky the inflation has been. And therefore, given both the large drivers of global economy, US and China, are going to face major headwinds over the next 6 months, I'm actually quite pessimistic about my outlook for global growth.
And how does India, stack up in that order? Do you see any challenges to India's growth outlook?
Yes, so I think India will have its impact from the global growth slowdown. India has strong domestic drivers, but it is also well connected into the global ecosystem, both from the manufactured exports as well as the growing services exports. As you know, services exports are already 10% of GDP and a big contributor to the economic activity here. Given the fact that we have already seen, even on the manufactured side, almost $40-50 billion the growth in exports. On the services side, if the listed IT services companies are any indicator, growth rates that were running in high teens to 20% are now expected to be in single digits. So there is a big negative delta on growth in that part of the economy. What is very promising is that on a broader basis, India's macro fundamentals remain very strong. If we see our stability indicators, including the current account deficit, the balance of payment, the forex reserves, they are very comfortable. And what that has meant is that even though because of higher global rates, there might be a volatility in the flow of foreign capital, that does not necessarily have an overbearing impact on the domestic economy. We are also seeing in the domestic economy the internal drivers remaining strong. So consumption has remained reasonably healthy, although it has not accelerated post-COVID across all segments as one would expect. We are actually now, after the period of 10 years, seeing a revival in investment activity in the economy on back of the fact that corporate balance sheets have been delevered. There is capex spending that is starting to come. Public sector capex has been very strong now for multiple quarters, and just in the last 2 quarters, we are seeing signs of private capex also coming in. So investment demand pickup is something that will add a boost to the Indian growth. On top of it, from markets perspective, we have seen improved corporate profitability. So corporate profitability that had fallen to just about 2% of GDP in the last few quarters has improved to 4.5% of GDP. So I think all these put together means that the medium-term outlook for growth in India is still very robust, even though in the short run it faces challenges of weaker global growth.
Now, coming to the second question, on the markets now, Indian equities have rallied sharply since March, and that's after a long lull of 18-19 months. And they've rebounded very strongly. But over the past few weeks, they seem to have
agree with you that there has been sharp rally. So if you see in the last 3 months, Nifty is up 6%, but if you look at the broader market, it is up much more strongly than that. And one of the triggers for this has been the fact that you have had foreign flows turning positive for the Indian market since April. Domestic flows over the last years have been consistently coming in, but foreign flow that had been absent for the last 2 years, and that had led to really markets going sideways for 18-19 months, turned positive, and there have been I think almost $20 billion or so of inflow since March, April. The trigger point for that change was again the surge in global liquidity in March, April after the SVB crisis, as well as the fact that global central bank stance appeared to be moderating, and you had long bond yield, US Treasury yields moderating by almost 100 basis points, right? But I think we have to be careful about the direction of foreign flows, because in the past 3 months now, if you see the US 10-year yield has gone up by almost 100 basis points. So from roughly 3.5%, it is now closer to 4.3%. So you have seen a pickup in global yields, and that does determine the near-term trend in capital flows, despite the fact that India's growth outlook relative to the global growth remains very positive. The fact that you have had this change in global rates again means that you might see volatility in global flows again. And that's a potential risk to the market. Domestic flows continue to be very consistent. I think we also, as I mentioned, are expecting corporate earnings to remain robust, but we need a phase of consolidation for really the earnings to grow into the valuation that the market commands. Right? So the fact that Indian market premium has expanded now is definitely a headwind to the overall market performance. So we should expect a phase of consolidation.
Now, coming to the risk that you've highlighted and the robust macros, one question that investors do have on their mind is how to then position the portfolios in the current context. One, where there is potential over the long term, but there are near-term risks. So how does one go about positioning the portfolio? And if there are any other structural opportunities medium term that you see?
So I think for portfolio positioning or for investing, one of the most important consideration is that you need to have a longer term outlook, right? So I think one should not look at portfolio or construction or portfolio churn on a 3-6 month basis. If we have a 2-3 year time horizon for investing, that is what should be the underpinning for the portfolio construction. When we at Axis look at our fund and the way we think about investing, we actually try to do it much more on a bottom-up basis rather than on a sectoral basis. So we try to identify companies that have quality management, have strong balance sheets, have either the industry-leading positions or positions in the market where they are gaining share. And it is by identifying these companies we kind of build up a portfolio for our schemes. Yes, there is a broader construct of the sectoral weights that comes into play, but it is more an outcome really rather than the starting point of constructing the portfolio. Today, for example, among the sectors we are overweight auto and auto ancillaries. We are overweight financial stocks. We are overweight some of the consumption names because we expect that after the last nearly 4 years of low growth, we should see some degree of revival. And the other key theme that we are playing is the revival of the investment capex, right? Because that had been missing for nearly a decade. And we believe now there can be a period of multi-year growth for companies in this segment.
Thanks, Ashish. Thanks for your valuable insights, and it's always a pleasure catching up with you.
Thank you, Ravi. Happy to be on this forum.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.